What is meant by the money supply? The term itself implies that a certain amount of money exists at any given time. In truth, there is no meaningful measure because of continuous variations as a function of demand. Simply put, money is cash on hand, the liquid funds that we have ready access to utilize in our daily lives. M1 includes the transaction deposits of banks and cash in circulation, liquid currency. M2 adds savings accounts, small time deposits at banks, and retail money market funds. M3 adds large time deposits, repurchase agreements, Eurodollars, and institutional money market funds. Although the United States has a larger portion of the money supply, the Eurozone comes in close behind, with Japan coming in third. The top three combined contribute 33 trillion of the total 50 trillion, or 66.2% of the total money supply. The European Central Bank is the central bank for Europe's single currency, the euro. Its main task is to maintain the euro's purchasing power stability in the euro area, which is comprised of 17 European countries that have been introduced to the euro since 1999. The Federal Reserve was first created to help the free market during its time in the slumps. Although the Fed was originally looked at as a last resort, the purpose it serves today is to stabilize the economy by managing the money supply. Three tools are used to control money supply and sustain growth: a change in the reserve requirements, a change in discount rates, and open market operations. The Federal Reserve sets the reserve rate. The reserve ratio is the percentage of reserves that a bank is required to hold against deposits. A decrease in the ratio will allow the bank to lend more, thereby increasing the supply of money. An increase in the ratio will decrease the supply of money. This powerful tool is rarely used, since small changes in the amount can cause big changes in the amount of money available and therefore have drastic effects on the economy. Here is an example of how the reserve requirements work. If the reserve rate were at 10%, the bank could only lend 90% of the amount it holds on deposit. For instance, if Bank A has a $100 deposit, it is required by the Fed to hold $10 in reserves. The remaining $90 can be lent. If this money is deposited at Bank B, this bank must hold 10% of the deposit, or $9, as its reserve. Bank B can loan out $81. This can continue until the original $100 has grown to be worth $1,000, as the graph above shows. The Federal Reserve can change the discount rate as another way to increase the money supply. The discount rate is the interest rate that a bank would pay to borrow money directly from the Fed, although the Fed is considered to be a lender of last resort. Loaning money puts more reserves into the banking system. The more money supply, the lower the interest rate. The interest rate correlates to the discount rate. Raising the discount rate lowers the supply of money, which increases the interest rates. The prime rate shown is the amount used for home loans, credit card debt, and personal loans. The open market is where the Federal Reserve uses the banks to control the money flow. In order to increase the money supply, the Federal Reserve will buy securities from the banks. These securities are then turned into cash and passed down to the consumer through loans. When the Federal Reserve wants to decrease the money supply, they will then sell the securities back to the bank. This will bring the money that was in circulation through a full circle and back into the hands of the Federal Reserve. Interest rates are working on a supply and demand process. When the economy is not doing so good, the Federal Reserve will lower the interest rate. This makes the idea of taking out new loans attractive due to the low cost involved. Doing this will pump more money into the economy. Once the economy starts to recover, the Federal Reserve will then raise the interest rates. If the rates are not raised and the money keeps getting pumped into the economy, we start to go into a hyperinflation process. Our presentation today showed that the U.S. and other countries decide on the total amount of money available based on the economic principles of supply and demand. It is a delicate balance. The more money that is available, the more money that is spent. The more spent, the more demand for goods, which causes inflation in prices. The inflation of prices causes the value of money to go down.